So big market swings can make all investors a little bit nervous. Though market volatility is typically normal, it can be very bad for retirees who are taking income. My guest is Mike Seibert, who practices in Allentown, Pennsylvania. Mike, thanks for joining us. Now, again, it's been said that market corrections can be far worse for retirees. Why is that the case?
Well, that's a big concern because a lot of the traditional financial planning that I see is really one economic power base. And what I mean by that, it's the investment industry. And the investment industry is really, really good at accumulation, but they're not so good at distribution. And there's reasons for that that's more in depth. However, the problem is that we have all this money and we've accumulated wealth. And really, we, as a consumer, the consumer's got it all wrong. What they really need to do is not focus on net worth, but let's focus on annual retirement income. How can I get the largest, most reliable retirement income stream the day that I retire?
So what are the two biggest retirement income problems you see today?
Well, there's the two main problems are, number one, longevity. When you retire and you're 65 years old, you have no idea how long you're going to live. People are living longer and longer and longer, and the longer that you live, more of these problems can pop up. More market declines, more tax law changes, cognitive impairment, et cetera. So, longevity is an issue, and the reason why is because we are now accumulating wealth, and now we need to take those assets we accumulated and turn them into an income stream. That's really hard. It's not the same as just accumulate your money and take out 4%. It doesn't work that way anymore. So what we're trying to do now is help a client realize that they're in a big financial catch-22 the day that they retire. If they need X amount of dollars to live at the day that they retire, they have to now be concerned about a distribution rate. The higher the distribution rate, 4, 5, 6, 7%, the higher the probability of them running out of money because of what we understand called sequence of return risk. You're never going to get a flat rate of return. And that's what I see with traditional financial planning is I'll see these fee-based plans, and the plans will show, yeah, if you're in a 6.5% rate of return on average, and you pull out 4, you should be fine. Well, yeah, but you're never going to get a flat 6.5%. So logic says the lower the withdrawal rate, the higher the probability that you're not going to run out of money. Well, here's the financial catch-22. By taking out less money, that solves the problem of not running out of money, but it doesn't solve the problem of living.
So, for example, when you're in retirement and taking income, how do you know if you're taking on too much risk?
Well, the other concern without taking out too much risk, because this is the funny thing, is when a person retires with X amount of dollars, and you really think about it, because it's kind of funny, and it really doesn't make any sense when you sit down and think about it, or people are taking money out, of their retirement accounts to live off of before they know what rate of return they're going to earn. So what if the market drops 20% that year? What's your backup plan? So now we have that problem and that issue that we have to address, but one concern that we have to then tackle on is, well, how much is too much? And the amount of money that is too much is based on Monte Carlo. And there's a lot of great websites out there that you can go to that are being created by the mutual fund industry. For example, Vanguard. Merrill Lynch has a great one where they talk and teach about what is Monte Carlo. And Monte Carlo is really gambling. We don't want to gamble with your retirement income proceeds.
All right, well, finally, Mike, I want to use an example here. What are the income tools available now to generate, say, $100,000 annually in income?
Okay, so now if you look at the screen and take a look at the chart that I have, this is a bunch of different products from banks, investment companies, insurance industries. And again, none of these are a one-fit, one-size-all type of product or one-size, one-fit-all industry. We need a combination of these industries. And let's take an agnostic view to financial planning. So if we take an agnostic view thinking that, all right, the investment industry alone is not where we want to put all of our money. The insurance industry alone is not where we want to put all of our money. However, if we use a combination of both industries, now we can get higher distribution rates. So let's take a look at the chart. Let's say we go to a bank and we put our money in CDs. Well, how much money would we need the day that we retire to generate $100,000 of retirement income at age 65? Well, that's $6.6 million we're going to need to generate $100,000 if we're in a CD at 1.5%. Then there's withdrawal rate simulations. And withdrawal rate simulations now are money sitting in the investment industry. And if we have all of our money in the investment industry, which traditionally, where everyone has their money, the safe withdrawal rate right now, and this isn't coming from me, this is coming from leading economists, is 2.97%. That's $29,700 per million. So if we need $100,000 of retirement income the day that we retire, we're going to need a little over $3.3 million in our investment pool. So the problem isn't the accumulation of money, it's these low distribution rates. So now let's take a look at the next one. Now we're involving the insurance industry with some of your money, the actuarial science, some of the guarantees now that we can help clients have in their portfolio. There are different types of deferred annuities with income riders, and these income riders guarantee the income stream at higher distribution rates. And so with that product, a variable annuity, index annuity with a joint income rider, that's income for two lives, husband and wife, that's a 4.5% distribution rate. You're going to need about $2.2 million to generate that. Next up, as we go higher, is called a joint life SPIA, or single premium immediate annuity. This is a payout for both the husband and the wife. And that's around like a 6%, 6.02% payout. And again, now we're getting into this guaranteed word, as you can see. Well, the assets we need to dedicate to generate $100,000 of retirement income is now only $1.6 million. Volatility buffer, which is a deep dive into how to take money from a investment portfolio when you retire, is basically don't keep pulling it out year after year after year from the same place. If the market's down and you're taking money out, we really need to give that portfolio a chance to breathe and take money from someplace else. That's called a volatility buffer. It's basically a non-correlated asset to the stock market. With that, you need about $1.6 million. And the product that generates the same $100,000 with the least amount of money is basically, it's called a single premium immediate annuity. It's your own personal pension plan with an insurance company. And again, all these products aren't for everyone, but with that product, you're only going to need $1.4 million to generate $100,000 of retirement income. So those are the products that you can choose from to generate $100,000 of retirement income. Obviously, they're all different. They all have their upsides and downsides. But these products should be used, not all, it's not one size fits all. It's a combination of these products.
My guest has been Michael Seibert in Allentown, Pennsylvania, and thank you for watching Retirement News Online.